G'day, I'm Vince Scully, Portfolio Manager at LifeSherpa Invest, and this is Investing. Today, we're going to pull all those pieces together that we've talked about over the last 3 episodes and use that to build a portfolio. This is where the rubber meets the road. This is where we use our knowledge to put together those pieces to build a portfolio that's going to help us achieve our goals. And that's what you're going to learn today. Let's podcast. We've looked at the building blocks of a portfolio, the 5 Bs, and the importance of considering risk. And today we're going to pull all those together into constructing a portfolio to meet your specific needs. And despite what you might think from reading the newspaper, this is not about lining up all the available options and sorting them by fees and past returns. That's a recipe for disaster. I like to think of it a little bit more like selecting the Australian cricket team, that you need a balance between great batsmen and great bowlers. And the order they play matters. And of course, you also need a good wicketkeeper. 11 pace bowlers does not a winning team make. A team of champions does not make for a champion team. And when it comes to investing and building a portfolio, the whole is more than the sum of their parts. And that is one of the most important lessons you can learn as an investor, and one that most people miss out on. So we came back to, at the end of our session on risk, we said that will tell us what asset allocation we need. So that is the spread among the 5 Bs, the 5 Bs being bills, cash, bonds, bullion being gold, bricks and businesses on the growth side. So I'll give you an overall high-level asset allocation. And remember, asset allocation drives 90% of the returns and risk in your portfolio. So once you've got to the Bs, you now need to identify one or more funds, because we don't do individual stocks here, one or more funds to represent each of the Bs that's going to form part of your portfolio. For most people, individual stocks, or bonds for that matter, are impractical, and therefore we should focus on pooled investments, whether they're managed funds, ETFs, or listed investment companies, or LICs. We'll talk in another episode about what each of those means when we come to selecting them. But now we're talking about putting them together. So for each B, or each part of a B, we need to consider whether active management can add value. Is there an appropriate index? And is there a fund that tracks that index? Now, lots of jargon in there, so let's unpack that slightly. The distinction between active management and what's sometimes called passive investing. I don't like the term passive because it's not a particularly passive approach. I rather think about it as being algorithmic or index-based investing. The concept of active management is that a portfolio manager seeks to choose individual stocks or bonds out of the universe and seeks to deliver a particular outcome. Sometimes that's a higher return than the index. Sometimes it's a lower volatility return than the index. But by selecting individual stocks, they do something different to what the index is doing in order to get a different return. And different in that context doesn't always mean higher. That is appropriate in some cases. In some cases, like small companies, for example, active management adds significant value. In bonds, it's almost impossible to fully replicate an index, and therefore most active managers, even most indexed bond funds have a high active share. And then, of course, we need to find a fund that tracks that index. Now, that does beg the question about what is an index. And an index historically was a tool to answer the question, how did the market go today? And we used to start with declines versus advances. Today, that's the equivalent of squinting at the screen and thinking, does it look mostly red or mostly green? The Dow Jones, about 30 stocks in the US, was one of the first indexes back in the 1920s, I think. And that was taking a little further and saying, well, not only will I answer the question about how did the market go today, but it will also help me benchmark my performance as a portfolio manager against the market as a whole. Some of these indexes have become so ingrained that they have become to mean the market. So the S&P 500, which is notionally the 500 largest stocks in the US, and I say notionally because it's not just a question of sorting the companies by size and drawing the line at number 500. There is a methodology in putting that together. And there's also a committee that meets to decide when things are going to be added or subtracted from it. So those rules and methodology for putting the index together mean that it doesn't necessarily reflect the performance of the top 500 companies, but it has become synonymous with the market. So most US large company portfolio managers will benchmark their performance against the S&P 500. And so it's an important measure. Of course, you can't actually buy the S&P 500. It's just a computer model. There are now a bunch of funds that called index funds that seek to replicate those. This is relatively new technology. It goes back to the early 70s. The Samsonite Staff Pension Fund was the first index managed fund. There was a Canadian launched one. And then, of course, Vanguard launched its big fund. So Vanguard is largely responsible for the growth of broad-based, low-cost index funds. They're clearly not the sole player in the market, but they are, I think, the number 2 fund manager in the world. And they've certainly done a lot of work in pushing down the price of these over time. These index funds are either managed funds, which is a unit trust, usually unlisted, or an ETF, an exchange-traded fund, which you can buy or sell on the stock exchange. And sometimes the equivalent is a listed investment company. We don't see too many of those in Australia, although many of our big listed investment companies do seek to track the index reasonably closely. But not all areas have a relevant index. So if we're talking about small companies or small value companies, if you go back to our discussion on factors in the previous episode, there is no index in Australia that tracks these. So once you get outside the top 300, the ASX 300, there is no tradable index that tracks those. So if you're going to hunt outside the ASX 300, and there are very good reasons why you should allocate some of your funds outside the ASX 300, you'll need to look at an actively managed fund, and usually that means an unlisted managed fund. That's not a particular disadvantage. It's just a fact of life. No index funds. And active management has demonstrably added significant value in that space. So just as an example, in the Life Sherpa Invest 90%, the Everest portfolio, about 13% of that is allocated to small companies. And that allocation, compared to putting that money in large cap, has added about 0.6% a year in net of fee returns. That matters. Look at each area, allocate within that, find a fund that aligns with that. And then once you've done that, you need to rebalance periodically. come back to what that means. So for most people's portfolios, at least in the accumulation stage of life, equities will be the largest individual components. That's B for businesses. That's the highest expected performance, highest volatility asset class. And that will normally be the largest component. But you do need to consider within that, you need to consider geographies. So how much in Australia, how much in New Zealand, how much in the US, how much in Europe, how much in emerging markets. You need to consider size. So how much am I going to allocate to big companies? How much am I going to allocate to small companies? What about industries? How much am I going to allocate to technology? How much am I going to allocate to finance? Choosing an index will dictate some of those. So if you choose the S&P 500 to represent the US, that is a bet heavily oriented towards technology companies. In Australia, if you buy the ASX 200, that's a bet heavily dominated by financials and resources. And market capitalisation, so the size of the company, is a pretty good way of allocating your money within a market. So if you're allocating money to large Australian companies, the capital weight that is cap weighting, that is the size of the company relative to the market as a whole, which is how these big indexes are constructed, is a pretty cost-effective, reliable way of allocating your money within a market and within an asset class. It's not a particularly useful way of allocating money between markets. So, for example, the bond market, the global bond market, is 20% bigger than the global share market. So if you were allocating in proportion to market capitalisation, that would lead you to a 55% bond, 45% equity allocation. And nobody in their right mind would be recommending that for an accumulating investor. Even in a retiree, that's still a very conservative allocation and is likely to result in lower outcome at a risk that you probably could have afforded to take a bit more. And lots of market commentators want to have a bet each way on this. So I've been listening to a leading US advisor. So he runs one of the big advice firms in the US. He consults to financial advisors. But he was arguing that because Bitcoin is 3% of the global investment pool, about the same as fine art, depending on how broadly you draw your definition of what a market portfolio looks like. So he would argue 3% of the market, therefore you should be investing 3% of your money. But on the other hand, he argues that even 40% bonds, well less than their market percentage, is bad. In fact, he's written a very famous article called The 60-40 Portfolio is Dead. So I would certainly agree that few investors should have 55% in bonds, but you can't walk both sides of that street. And so just because Australia is 2% of the world stock markets doesn't mean that you should invest just 2% of your money in Australia. There are very strong reasons why you should have way more, perhaps as much as 40 to 50%. This is often dismissed or derided as home country bias. Even that word sounds like it's bad. But in many ways, it's a good thing. After all, you earn in Australian dollars, you get taxed in Australian dollars, and you're going to spend it in Australian dollars. So as an Australian investor, you need to have a substantial allocation to Australian markets, both in equities and in bonds. But like a lot of things, just because some is good, more isn't necessarily better. I've seen portfolios with a 75% Australian allocation, which to me seems way too concentrated and lacking in diversification for most people. There are presumably some circumstances where it might be appropriate. but they would be few and far between. Similarly, the USA is now 2/3 of world market capitalisation. But that doesn't mean you should be allocating 2/3 of your money to the US market, which would be the case if you simply bought a global equity index. So if you bought VGS, the Vanguard Global Share Fund, that tracks a global index in which the US will have a 60 to 70% weighting. The US is about 26% of global GDP on a nominal basis, or 15% on a purchasing power parity basis. And we prefer to allocate on this more fundamental basis. And now you need to remember that not everybody in the market is playing the same game. Market capitalisation is a function of buying interest. So more people buy in the US, the more the US forms part of those indexes. Many US investors simply don't invest overseas. And certainly if you've read J.L. Collins' Simple Path to Wealth, most don't, certainly retail investors. Most professional investors are required to stick to their mandate. So they might be running a global value fund, which will require them to be fully allocated at all times, even if they form the view that global equities are a poor investment. Other investors, like insurance companies, are in the markets to hedge risks. So they've got obligations to policyholders and investors to deliver future returns. So they need to hedge those risks away. So none of these make global market capitalizations a particularly useful guide for allocating money between markets. That's where the smarts in putting a portfolio together. So the question arises then, well, once I've identified that I need to be in Australian small caps or Australian large caps or Australian bonds or global bonds, whatever the asset class I'm looking to invest in and the sector of that market I'm looking to invest in, I now need to choose a fund. And broadly, you have a choice between active managers and so-called passive managers. And one of the first questions that many investors ask, and I certainly get asked this question day in, day out, is which should I choose? Should I go passive or active? And in many ways, that's the wrong question. That this is a little bit like going into a bottle store and asking the shopkeeper whether you should buy bottles or cans before you've decided what you're going to drink and where. So if you're going camping in the summer, you're probably going to want to drink beer. Cans are lighter, easier to carry, and can be cooled quicker, therefore you probably want to buy your beer in cans. On the other hand, if you're having a steak by the fire in winter, you're probably going to be drinking a full-bodied Shiraz, so a bottle, and almost certainly one with a cork, will be the answer for you. So that's why you've got to look at what you want to drink and where you want to drink it first. So what are you seeking to buy? Does an index exist? And is it appropriate for your needs? So I don't really believe there is such a thing as passive investing. Choice of an asset class is an active decision. Choice of an index is an active decision. And choice of an index fund to track that index is an active decision. So I rather think about whether I'm getting an active manager or I'm getting an algorithmic manager. Now, algorithms, which is really a computer choosing the funds, that could be following a quantitative algorithm. It could involve tracking an index. There are lots of ways you can build a selection or portfolio of stocks or bonds without having an expensive manager looking after it. And the key here is to use the right solution for each asset class. So let's have a look and see, well, what is an index fund right after this break.
This Is Investing is brought to you by Life Sherpa Invest. If you want your money to work harder and not just sit in a savings account earning crumbs, check out Life Sherpa Invest. Choose from 4 risk-based portfolios like Everest 90 with 90% in growth assets. Long-term, low-cost and built for people who are after serious returns. Invest from $5K today at lifesherpainvest.com.au/invest and start climbing.
When I look at an index fund, I'm looking for 5 or 6 measures in choosing which one. So the first question, which I guess is possibly obvious, is what index does it track and how is it constructed? That is, how is that index constructed? So this matters. Each index, and usually most markets have multiple index providers. And so over the past 2 decades, the difference between the major providers, that is MSCI, Morgan Stanley Capital Investors, FTSE, Financial Times Stock Exchange, that's the London Stock Exchange, and Standard & Poor's or S&P. They're the 3 main players, and they maintain indexes in most markets in the equity space. The difference between those indexes has been about 1% a year in developed markets and about 2.7% in emerging markets. So which one of these represents the market? Well, the answer is sort of all and none. Some of them have become the de facto measure of that market, but choosing the index matters, particularly when it comes to international. They don't all treat countries the same way. So Korea is a developed market, or South Korea that is a developed market in some indexes. It's an emerging market in other indexes. Some indexes include companies with secondary listings. So in Australia, the S&P ASX 200 includes companies have a primary listing overseas. So companies like Fisher & Paykel and a number of other New Zealand companies have a primary listing in New Zealand. They're also listed on the Australian Stock Exchange. S&P includes those in the ASX 200. The equivalent FTSE Russell Index doesn't. Some indexes include companies whose primary business is investing. Berkshire Hathaway is included in the S&P 500, but it's not included in the FTSE Russell equivalent. All of these make material difference to what you're buying, and understanding what you're buying matters. The second thing you should look at is how does this fund replicate that index? Does it simply go and buy everything in the index, which is called full physical replication? That's generally the preferred option when it comes to equities. It's not really possible when it comes to bonds because there are just thousands of components of the bond index, many of which don't trade particularly frequently. So a fixed interest ETF will almost certainly have a high active share. That is, its holdings will differ materially from the underlying index. The skill of the manager is to replicate the characteristics of that index. So for fixed interest, that's around credit rating and duration generally. Other funds seem to seek to try and replicate the index by using derivatives. Not a lot of this in Australian listed ones, but they're certainly active overseas. And you may find it in inverse funds where the value of the fund goes up when the value of the underlying index goes down, or in geared funds. The third aspect is size. Bigger is usually better because many of the costs of running a fund are fixed. So Vanguard Australian Share Fund is 22 billion or so. That's the biggest one in Australia. Anything less than about 100 million should raise questions. The risk of a very small fund is that it proves unprofitable for the manager, and so they close it down, meaning you've got to replace it, and that may trigger capital gains tax and all sorts of other nasties that you don't want. So we like to see 100 million or so. It's less of a concern for ETFs than it is for managed funds, but it's still important nonetheless. The fourth thing you need to look at is liquidity. So that is how much of the fund changes hands every month. And you're really looking for somewhere between 1 and 5% of the fund changing hands every month. The greater liquidity generally equates to quicker sales. So if you want to sell, the more liquidity, the faster you're going to get filled. And it also usually leads to lower spreads. And the fifth aspect is tracking error. Now, this is a two-edged sword. Now, tracking error is a measure of how closely the fund tracks the index. And generally, closer is better. And closer in this context generally should be less than 0.10%. And that's significant. I mean, if you think about the fees on some of these funds are going to be sub 0.1%. So a tracking error of 0.1% is material. Now, tracking errors of themselves are not inherently bad when it comes to funds management generally. But when it comes to index funds, it is a critical measure of how successfully they track the index they're purporting to offer. And the downside of a low tracking error is that it contains hidden trading costs. These are costs that won't show up in the management expense ratio or indirect cost ratio, and it won't show up in returns relative to the index. And this is one of the hidden costs of index funds that usually gets overlooked. And this usually occurs around what are called reconstitution events. So that is when the index provider adds or deletes a company from the index. And usually these events trigger a fair bit of trading so that the index fund must sell the ones that are being deleted and it must buy the ones that are being introduced. And to minimise the tracking error, they're usually going to buy those at the close on the day of the reconstitution event. And we know that the average daily volume of those stocks tends to rise 20 to 50 times over the days following around the reconstitution event. And in fact, there are hedge funds who exist solely to exploit this inefficiency in the market, that these managers have to buy on the day, and they usually buy it on the close. And this puts index managers at a considerable disadvantage because if you're an active manager, you obviously don't want to publicly announce your trades, but here the whole market knows what you're going to buy and when you're going to buy it, and there's a whole industry in front running those things. So the evidence is pretty strong here. So if you look at the decade to December 2023, the stocks added and dropped from major indices had their price deviate by 3 to 5% relative to other stocks in the index. Now, in the context of a fee of 0.04%, that is material. So the consequence of that is that index fund managers systematically buy high and sell low, and this creates performance drag. It's not going to show up in the index, not going to show up in the fund, and it won't show up in your MER, but it is eating into your returns. Now, this may be a price that you're prepared to pay in a large liquid market where being an active player is tough. But when you add that problem to the fact that many companies, particularly in the US, where there is a profitability hurdle and a committee meeting to get added to the S&P 500, many companies deliver their best returns before they get added to the index. So Lululemon and Tesla are perfect examples here. This is a trade-off that you need to be aware that you're making. It's not to say that index funds are bad. We use mostly index funds, but we are aware of these and we are aware of where other algorithmic approaches may add more value. The next thing you need to look at is fees and costs, and you'll notice that this is now number 6 on my list. It's not number 1. So fees and costs matter, but they are secondary to the am I getting what I need first. So price only matters once you're getting what you need, and small is usually good. In practical terms, prices for managed funds or for index funds are trending to zero. 0.04%, 0.07%. These are as good as zero, and there's not much to choose between the two. Obviously, like for like, you would choose smaller over larger, but you do want to make sure you're comparing like with like. And just to put that in context, we are about to hit the 30th anniversary of the launch of the first Australian ETF. The one that still exists, of course, is STW, the State Street Index Fund. But there was one before that, launched by Salomon Smith Barney, which was launched in February 96. And it was launched with a cost of 0.95%. Today we're at 0.04. So this is a world of technology changing the way we invest. In fact, when I first started to invest in London in the early 80s, the government regulated the price of trades. So typically you were paying 3% with a floor for brokerage, and you were paying 0.5% for stamp duty. So it was going to cost you £35 to make a £1,000 trade. £35 in 1983 was a lot of money. And of course, we were still trading on paper then, so your settlement period was 10 days. Today it's 2. So technology has made this stuff a lot easier. And the final measure to look at is spread, sometimes called slippage. You really want to look at something as low as 0.1. Obviously, the bigger the fund, the lower it should be. The bigger the market is playing in, the lower it should be. Vanguard Australian Share Fund is sitting at about 0.02. But anything below 0.1 is pretty good. This used to be a big deal. It's becoming less and less a deal. So that's how you choose an index fund. And that's probably a little easier than choosing an active fund, where the differences between one manager and another become more and more, and access to information becomes less and less. So when we look at selecting a manager or a fund or both to add to our portfolios at LifeSherpa Invest, we follow a methodology we call the 6 Ps. And that is, we start with the manager, and the inputs to this really are who's the provider, so how long have they been around, what do they manage, who are their clients, who owns them, and how much the the portfolio managers own in the fund. We like a fund manager where the portfolio manager has most or substantially all of their personal wealth in the fund. That one of the biggest indicators of a successful active fund manager is that the portfolio manager is heavily invested in the fund. The second P we look at is people. So who's the manager? What's their bench strength? What happens if he gets run over by a bus? What's the turnover in the team? How are they planning for succession planning? And what's the track record of the people? Active funds management is a people business. And so you want to make sure that you're getting access to the right talent. The third P is philosophy. So what is the guiding principle behind how they invest, how they choose assets for the fund? Is it aligned with our investing philosophy? And is it aligned with our goals for that asset class? Can they clearly articulate it? Does it make sensible? Is it enduring, or is it a function of today's market conditions? How well is this shared among the team? Depending on the portfolio, what is their attitude and their methodology for dealing with environmental, social and governance issues? And then the fourth P is process. So it's one thing to have a great team and a great philosophy, but you want to make sure that there is rigour in how they are applied so that that process is transparent, it's clearly articulated, it's repeatable, and it's stable, and that they can clearly articulate how every member of the portfolio aligns with the philosophy. And then and only then do we start looking at the output of all of those processes. So we look at the portfolio, which is the fifth P. So what's in the portfolio? How transparent are they? Some fund managers only list the top 10. Obviously with an index fund, you know precisely what's in it because it's published every day. Active managers obviously do need to protect their intellectual property, but we do like to see transparency. So does the portfolio clearly align with their philosophy and process? What's their story for every component of the portfolio? There's got to be a reason why it's there. And they should be able to clearly and openly explain the losers. The thing about active management is you have to do something materially different to the index to get a materially different answer. And sometimes that's going to be different good, and sometimes it'll be different bad. Sometimes, if you're dealing with a factor investor, you would expect it more often than not to be different good. And certainly you want the numbers to fall down on the different good. And then finally, we look at performance. And that really is looking at, well, how do they perform against their benchmark? Is that an appropriate benchmark? Have they got a performance fee? What's the history of them earning their performance fee? And how consistently have they applied it? One of the biggest dangers in active fund management is style drift. That is, they claim they're a large company value investor, but when market sentiment moves against value, which it has done for much of the last 3 or 4 years, where it's been a growth market dominated by the Magnificent Seven, have they stayed the course? Have they stuck to their process? Have they stuck to being a large cap value manager? You want to see consistency. You want to look at costs, of course, and you want to manage turnover. So high turnover generally means more of your return is generated as short-term capital gains, which don't benefit from the capital gains tax discount. So there is a cost to that. But that needs to be seen in the context of what type of manager this is. If they're a momentum manager, you might expect holdings in the days or weeks. A long-term value manager should be holding in the years potentially. So all of the things go into how we assess an active fund. And having put all that together, you now need to monitor and rebalance your portfolio. And this is often where the magic happens. So you need to keep an eye on it. And there are 4 main things you need to be doing here. So the first thing is tax tracking. And in a world where autofill on MyGov deals with much of the distribution side of this equation, it can be easy to forget this. But tracking your capital gains tax is complex, especially if you're dollar cost averaging, you're putting money into the market every month, and you're regularly balancing, or, which we generally discourage, you've got dividend reinvestment plans ticked and you're getting parcels issued every time the company pays a distribution. All of these lead to dozens, if not eventually hundreds of parcels. And so when you come to sell, especially at a rebalancing point where you're not selling your whole holding, you need to decide which parcel I'm going to sell, and you need to be able to track the cost base of that parcel. That cost base, which determines how much capital gains tax you're going to pay, is a function of what you paid for it, plus the brokerage when you bought it. It's also changes with the distribution. So if you read your tax statement that the manager issues, you will often have a cost-based adjustment in those distributions. Usually those distribution adjustments tend to increase your cost base more than decrease it. And so if you don't track that, you'll likely be paying more capital gains tax than you should. And by being able to track your parcels, you can then choose that when you rebalance, do I want to choose a parcel to generate a big gain because I've got a loss somewhere else, or do I want to minimize my gain? And there are tools like ShareSite. So you'll need the paid version to do that. And if you're a Life Sherpa monthly member, you will get a free pro ShareSite subscription. Or alternatively, and the more practical way for many people is to use a wrap account. So that's tax tracking, really important. Yes, it technically can be done on a spreadsheet, but it's really tough to keep it up to date and do this. And having reconstructed enough deceased estates where shares have been held potentially for decades, trying to recreate the cost base to settle up the deceased estate, that is a job I do not wish on my worst enemies. It's getting a little easier with technology, but it's still time-consuming, painstaking, difficult, and if you're paying for it by the hour for your accountant, very expensive. So get your tax tracking right. The second thing you need to do is track your performance. So how am I doing? How's my portfolio tracking against an appropriate benchmark? There's no point in tracking a balanced 70% portfolio against the S&P 500. You should expect over time to underperform the S&P 500, but that's not the point. What is an appropriate benchmark to track your 70% portfolio against? And where do you get the data? Thirdly, you need to look at the changes to the funds and index that you're invested in. These change all the time. So we've seen global equity indexes now being dominated by the US, and that may or may not suit your needs. Within the US, we're seeing the tech companies dominate that index. And in Australia, we're seeing the big banks dominate ours. Those weightings change over time. That's one of the beauties of index funds, but it's also a negative because what you bought 5 years ago is unlikely to look the same now as it did then. Funds change the indexes they track. Beta Shares has changed quite a few of the indexes they track, as has BlackRock. So when the Beta Shares Green Bond Index went from being a 50% global, 50% Australian to being 100% global, that's a material change to your asset allocation. So did you read the significant event notice you got sent on the email? Did you understand what it meant, and did you know what to do about it to maintain your asset allocation? All of those take time, focus, and concentration, which for most people is time best spent being with their family, being the best they can be at their job, and enjoying life. And it's easy to get a little bit carried away when we start looking at basis points. That's 0.01%. So if you're paying 0.65, which is the platform and fund management cost on Life Sherpa Invest, that might sound like a lot of money compared to our Vanguard 0.04% MER. But put in context, that's $65 on a $10,000 portfolio, $650 a year on a $100,000 portfolio. So how much time are you prepared to spend to avoid that? How much risk are you prepared to take if these monitoring events are not done on time and appropriately? That's the question you need to ask yourself. And that brings us to rebalancing, which is the final one. And this is something that's easy to do on a spreadsheet, but psychologically really hard to do in practice. The purpose of rebalancing is to get back to your asset allocation, which, as we said at the outset, determines 90% of your risk and return in your portfolio. The benefit of it is that it forces you to sell the stuff that's performed well recently and therefore likely to underperform in the future because of reversion to the mean, and to buy what's doing badly. This is buy low, sell high, but psychologically it can be tough to be disciplined about this. And if you leave it to a manual intervention where the temptation is, I'll leave it for just another month, then you can end up with a highly skewed portfolio, which is not where you started out. And bear in mind that that is something different to what a trader would do. So if you're a long-term investor, you want to be rebalancing to your long-term asset allocation on a regular, systematic basis. If you're a trader, you want to cut your losses quickly. So when a position no longer meets your investment thesis, you should cull it ruthlessly and let your winners run. And that's because what you want to do is you want to make more money on the winning trades than you lose on the losing trades. So that as long as you are 50-50 or better and you lose less on the losing ones, you're going to come out ahead. But that's a trading mentality. That's not a long-term investing mentality. Each of these strategies has their place, but if you're a long-term investor, and we're long-term investors at Life Sherpa, then you should be rebalancing back to it. It's not necessarily about increasing your return, although it can and often does. The difference is relatively small, so the evidence suggests that the return benefit is between 0.05% and 0.2%. So not a lot, but the bigger benefit is it reduces your volatility by 1.5 to twice as much. So that's the benefit. So you get a tweak on your returns and you get a tweak downwards on your volatility. So in the words of Burton Malkiel, the Random Walk on Wall Street guy, and Charlie Ellis, the author of The Loser's Game, great book, recommended. They say that rebalancing reduces the volatility and riskiness of your investment portfolio and can often enhance your returns. In the long run, and this is the important point, investors who rebalance their portfolios in a disciplined way are well rewarded. And that's a lesson that we all need to learn. And so in some ways, just pulling this all together, in some ways, creating a portfolio is the easier bit. Keeping it on track is the hard and unglamorous bit. And that's why ongoing management is so important and worth paying for. And that's in contrast to what many beginning investors say. Many investors come to us and say, look, I'm happy to look after this myself. I just need some help setting it up. And my view on that is, if you know how to do the hard bit, the keeping it on track, you should know how to set it up. And if you don't know how to set up, you by definition don't know how to manage it, because that's the harder piece of the job. So we will generally not indulge that sort of position. We'll give you a strategy which says you should be 80% growth, But to turn that into an actual portfolio, that would be negligent of us not to provide the ongoing stuff. And that's partly why we make our portfolios available direct to investors who are capable of doing that first bit themselves, and they just buy one of our portfolios, which you can buy online at from $5,000. So pulling all that together, you need to build a portfolio that has got the capability of delivering the returns you need at a volatility that you can tolerate, and spread it across the 5 Bs using the appropriate mix of active and index and algorithmic fund managers, and make sure that you nurture it. You don't need to watch it every day. You probably shouldn't be looking at the value every day, but it is important that it be nurtured. And we know you've got a life to live. So that is the pulling it all together. Over the next few episodes, we're going to look at some specific ways that you can, pick a Australian equities ETF or global equities. And, as always, if you've got any questions for us here at This Is Investing, put a question in the Money podcast Facebook group and tag me, Vince Scully, on the note, and we will get to it in a future episode. So that's it for now. See you next time when we do This Is Investing.
Thank you for listening to This Is Investing. Any advice is general financial advice and does not consider your objectives, financial situation, or needs. You should consider whether the advice is appropriate for you before acting. Always read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs before buying any financial product. Vince Scully is a representative, and Simo Interactive, Pty Ltd, and Glenn James are authorised representatives of Money Sherpa Proprietary Limited, which holds Financial Services Licence 451289. And if you want further investing fun, the Quick Start Guide to Investing, as endorsed by Vince, obviously, is available wherever good books are sold, or there's a link in the show notes to get your copy today.